Hi guys, today I want to tell you about taxes. Yes, this is my lecture, Tax 101. Stay tuned. I'm Sunday Babalola. I'm a professional tax preparer. Do you feel like filing tax is a problem for you every year? Every year, once in a year, you have the problem of headache. You don't know what to do when you get your W-2, 1099. You're just confused? Yes, it is difficult. Filing taxes is difficult. This is the news that was years back in 2014. It was reported that the United States tax code is about 3,951,104 words long. That is twice the length of King James Bible and the full works of William Shakespeare combined. But this is the good news. Many people can skip these processes when preparing taxes. Once you understand the basic fundamentals of preparing tax returns, then the details and exception becomes a lot more easier. Yes, it becomes more easier when you understand these fundamentals. Just relax, clear your head, and think of the big picture. There are just few equations and vocabulary involved in all this. The rules are very simple, very simple. Here is the first equation. Adjusted gross income minus deductions and exception equals taxable income. Gross income means total income before taxes. Adjustment, deduction, and exception are different. These are just ways to reduce your income that is taxed by the government. Now, the only thing you need to know is your taxable income. Once you know your taxable income, the next step, taxable income times tax rate equals your tax liability. Tax rate depends on your income. Your tax liability is the amount you pay to the government for the whole year. Now come to the point of the great reconciliation. Your tax liability minus credit and payment. If your credit and payment is less than your tax liability, that means you owe money to the government. Mr. Sam is going to come after you. If what you get through credit and payment is more than your tax liability, you get money back. Everybody loves that. Now let's examine all these three equations closer. First, I'm going to talk about the income, your income, the money you make every year. Your salary, your tips, gambling wins, all this income that is stated on your W-2 and 1099, all this money are income except some exceptions. The government wants you to pay your fair share, which is your tax. There are copies of forms to standardize the reporting of income. All forms like the W-2 or 1099 will be given to you by your employer or a third party that will be reported to the IRS. They will have two copies of that. They will send one to you and they send one to IRS. The exception to that is when you have $600 or less in a year. In this situation, you might not receive a 1099, but you still have to report the income. Outside the W-2 and business income, other type of incomes are Social Security, unemployment benefit, and retirement benefit. Now to calculate your income, you just add up your W-2, your 1099, and any other cash income that has not been accounted for. The tax software will help you in adding all this together so you don't have to model it all. All you need to do is just to follow the instruction on your tax software. As long as you understand the fundamentals behind the calculations, just let the system do the rest for you. After you've added everything up, the IRS allow you to deduct some expenses from your taxable income. This is called adjustment. You can claim adjustment even if you decide not to itemize your deductions. There's some adjustment you can deduct from your total income to give you your adjusted gross income. Now that you understand what adjusted gross income means, you cannot still calculate your tax yet. You can still reduce your income through deductions and exemptions. So when it comes to deduction, you can itemize your deduction or you go by the standard deduction. Itemized deduction is when you add up all the items IRS will allow. Or maybe your standard deduction is even greater than the itemized deduction that you have. Every year, IRS make adjustment to standard deduction and publish it. So if you don't have big expenses to itemize, your chances will be to go with the standard deduction, especially if you're married or head of household. This brings us to exemptions. Exemption is like a kind of deduction, but they are more simpler. Exemption is basically an additional amount that a self-supporting taxpayer can deduct from their taxable income. You can claim exemptions as long as no one can claim you as a dependent. You get one exemption for yourself and one exemption for each person listed as a spouse or dependent on your tax return. Each exemption is worth the same amount. For example, let's say you're married and you have 2 kids. That's 4 exemptions. Single and supporting your mom, 2 exemptions. A student filing a tax return but being claimed by your parent as a dependent, 0 exemptions. For a single person without no dependent is 1 exemption. So after all this adjustment, deductions and exemption, what is left behind is your taxable income. Your taxable income times your tax rate equals your tax liability. Your personal tax rate is determined by your income and is progressive. Some who make very little may only pay 10% of their taxable income. Some who make more might pay up to 35%. The more you make, the more you pay. To know what your tax rate is, visit the IRS website for your tax bracket. Your taxable income times your tax rate equals your tax liability. In other words, that is what you need to pay to the federal government. Now to the juicy part. Just because you know what to pay in taxes does not mean you owe all the money at tax time. This is where people get confused sometimes. Chances are you've had so much money taken out of your paycheck throughout the year. Great news, that counts towards what you owe. These are called payments and they are added up and listed on your 1040. In addition to payments, some taxpayers, especially from low to moderate income, credit are there to reimburse you for things like going to college, saving for retirement, or paying for daycare while you work. The EITC can amount to more than $6,000 for a family tax bill. EITC is the biggest anti-poverty measure in America. Families eligible for the EITC can actually go from one side of the poverty line to the other. So if you add up all your credit payments throughout the year and it's more than your tax liability, then you get a refund. If they are less than your tax liability, then you owed money. Sorry. Now let's summarize. Taxes may look difficult, but we have a process that simplifies it. Adjusted gross income minus deduction and exemptions equals taxable income. Taxable income times tax rate equals your tax liability. Your tax liability minus credit and payment equals what you owe or what you get back in refund. Thanks for watching. Please subscribe to this YouTube channel. If you find this helpful, please share it. I am Sunday Babalola.